Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that.
Chicago soybeans. Okay, so for many months now I had started here with my longer term monthly charts, as the market, since as far back as the low seen in August 2024 till October 2025, built a sideways action. I noticed this action 64 weeks ago, around a year and a quarter now, and this sideways action had a breach, serious breach, in January this year, through March and into April, and now into May. Prices have now consistently closed and stabilized over the 3-year moving average, which is currently 11.39 and a quarter. However, the key feature which I wanted to make you aware of is the bright red neckline, currently 12.16 and a quarter, which you can see redrawn here on my daily chart from my longer term charts, a little above the current market. This bright red neckline has been pierced on the upside, but not as yet properly broken, and is the key to the longer term action here in this market. Monthly consecutive closes over this bright red neckline will see the termination of a huge December 2020 to January 2024 head and shoulders top, with all the subsequent consequences, especially on the downside, or shall I say the failure to push on down. This is something to keep in mind as we go forward. So, coming back to the very recent action, this had seen a small rising wedge pattern formed over April from an earlier sideways action that had even earlier been the exit from a small bull channel. However, we have seen prices break on the upside 3 times in the last 3 weeks, and twice on the downside within the last 2 weeks. The second time has been more sustained move lower, which we are still sitting within just about. So as I said 2 weeks ago, this pattern is compromised. Indeed, I have looked for an alternative. I didn't have to look far, as if we step back just a little bit, we can now see a March to date based very shallow bear channel. Currently 11.54 and a quarter to 11.51 and a quarter to 12.29 and a half, and it's highlighted in bright green on my daily chart. It's not an ideal pattern, but it does fit in with the recent action just about. At the moment, the market continues to be midway between the shallow bear channel lines, with some considerable congestion below formed over March and early April, between roughly 11.93 to 11.70. Thus, we have some pretty good looking support below right now and some potentially good resistance further above. But this overhead resistance can be pierced. We now come to the action 2 weeks ago, which ended up as a weekly key reversal down. Initially, there was no follow-on lower. However, this has changed and prices have moved down below the green short medium moving average, currently 11.89 and a half at the start of this week, but have moved back up over it just about today. It's not closed yet, and we're actually on it at the moment. The market has found some support from the congestion seen between 11.70 to 11.93 and a quarter, created between mid-March and mid-April. This leads me to what is the consistent big picture, the bigger picture here actually, and in this prices are still well within the dark blue December 24 to August 25 bullish Andrews pitchfork, in between the dark blue middle tine above, currently 12.57 even, and a dark blue lower tine below, currently 11.38 and a quarter. This is the key overall pattern that has been driving force higher here since August last year. Chicago soybean meal. Overall, the market continues moving up nicely within the main pattern here, which is the bright red late September 25 to mid-January 26 bullish shift pitchfork, specifically between the bright red lower tine below, currently at 318.10, and the overhead bright red middle tine, currently 344.90. This middle line has been especially good at capping prices since late February, though more recently, indeed 2 weeks ago, the 61.8% absolute Fibonacci line at 338.30 has taken on a little of that role. Below this bullish shift pitch hook, we have the significant dark blue trendline extension, currently 311.20, of the July to September 2021 descending triangle, which had previously acted as an attractor for the market and then later as a base for the moves higher over late February, March and the start of April. Now, we also had the 50% Fibonacci line of the May 24 to July 25 move at 326.20, originally capping prices, then starting to act as a support, but now once again as a resistance. This is where what had been a word of caution on my part in the past, but which now is an observation and is worth repeating. I said 9 weeks ago, and I quote, should prices turn back up, especially if we start closing over the 50% Fibonacci line, the next choice will be the bright red middle sign. But a word of caution. You see, the bright red middle sign is now awfully close to the 2025 high at 333.5, and they together may be a stronger resistance than each individually. I suspect any reversal back upwards will very much depend on maintaining what we have seen since the beginning of this year, with the low in early to mid-January. We have so far had rising lows, a very definitive bullish sign, and that depends on the market not pushing down below 308.90. End of quote. We have continued to see generally rising lows and higher highs. Indeed, since the start of this year, we have seen this, bar one single aberration, this pattern going through in one single aberration, as the market continues to be caught between the bright red lower time below and the bright red middle time overhead. For now, I will continue to watch this ersatz bull channel develop, especially that potentially significant resistance, the 61.8% absolute Fibonacci line. This leads me to my final point, also a word of caution. This commentary would not be complete without my discussing a portion of my commentary which I have repeated for 156 weeks, so for 3 years now. It is the annual key reversal seen here at the end of 2023. I said back then, and I quote, I now only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we've been living in the shadow of this pattern ever since. End of quote. Now, I've also added ever since, and I quote, if there's only one thing you take away from any of my musings, let it have been those words. End of quote. For 3 years, the shadow of that pattern has darkened the skyline of this market ever since. I wonder, and continue to wonder, is a more apt description, if prices are now finally exercising that shadow, that dark shadow. However, please bear in mind we are still significantly below the close of 2023. Chicago soybean oil. There is one pattern here that has defined moves higher this year, even when it was and is being thoroughly tested. It is the bright pink March to August 2025 bullish Andrews pitchfork. With the bright pink upper time, and that's currently at 74.47, capping the market most of the time. We had broken up through this pink upper time 4 weeks ago, but then late 2 weeks ago, and again last week, as well as this week, though we may be changing, we are back below this upper time and within the pitchfork pattern, possibly making the push higher over the upper time only a possible breach that may be in the process of being repaired. Now, this breach higher prompted me last week to draw a mid-March to mid-April bullish Andrews pitchfork, though this also saw a breach 3 weeks higher on the upside and has since been repaired, and a breach this week on the downside, which has also been seemingly repaired. We are back now to being caught and squeezed between the bright pink upper time overhead, currently at 74.47, and now the dark blue rising lower time below this new pitchfork, currently at 73.38. Interestingly, we are very, very close to creating a weekly key reversal this week. The downside on this pattern has been done, but we would need a move this week over 74.46, which is not that far. and then a close on Friday either over 72.26 or under 72.17. But only if prices can reach and exceed 74.46 by Friday's close. This leads me to something I spoke about 4 weeks ago when I said, and I quote, "What is noteworthy is that we saw the development of an ascending triangle over March and April, but which has now turned out, it seems, to be a bullish halfway hesitation." Last week, so that's actually now 5 weeks ago, last week prices broke up through what seems to be the top of the hesitation part of the halfway hesitation, specifically the congestion between 68.71 to 69.12, and made the March action into the hesitation part of a very large bullish halfway hesitation. This leaves us now excluding the area of an ascending triangle with a few distinct possibilities for the bullish halfway hesitation. Thus, if we measure from the start of February low, then we have a primary target X up in the 75.40 area, so not too far above, and a harder to reach secondary target X1 up in the 82.10 area. If, however, we measure from the deeper December 25 low, then we have a primary target X2 up in the 78.45 area, and a harder to reach, much harder to reach target X3 up in the 87.20 area. It'll be interesting to see how the market deals with these potential targets. End of quote. Well, 3 weeks ago, prices reached the first easy primary target X at 75.40, but this still leaves open targets X1, X2, and X3. I think for this market, the question, once again, is not whether the market is bullish or not, but how bullish does this market choose to be?
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.